Let me say something that shocks almost every real estate investor the first time they hear it. The year you stop working is often the year you pay the most tax in your life. Not when you're hustling, not when cash flow is strong, not when deals are closing back to back. After you retire. That's the moment most people assume their tax bill should finally go down.
Wait, what? That sounds backwards.
Exactly. And that's why it catches people off guard. Welcome to Ivy Smart Talks. Today we're explaining why this happens and what smart investors do before it's too late. Most people believe one simple idea. If I retire, I earn less, so I pay less tax. And to be fair, that logic does work for salary. When wages stop, withholding stops, paychecks disappear, and taxes usually come down with them. But that logic breaks when real estate is involved. Because real estate income doesn't follow your work schedule. It follows timing, depreciation, deferred gains, passive activity rules, required distributions later on. All of those are running on their own clock, whether you're working or not.
So, real estate didn't get the memo?
Nope. Real estate plays by a different clock. During your working years, real estate usually feels easy from a tax standpoint. Rent comes in. Depreciation offsets income. Taxes feel light. Cash flow looks clean. On paper, it feels efficient, manageable, almost quiet. And because nothing feels urgent, most people relax.
Honestly, that's when I stopped worrying.
Most people do. That's not a mistake. It's just incomplete planning. If today's low tax bill is making you feel handled, ask yourself one question. Do I know when this bill shows up later and how big it gets? That's the part most investors never pause long enough to examine. After retirement, three things often hit at the same time. Not years apart. Not one by one. Together. First, you sell. Properties you've held for a long time finally come off the books. Second, retirement accounts force withdrawals. Not because you need the money, but because the rules say it's time. And third, salary disappears. The steady W-2 income that used to smooth everything out is suddenly gone. Each one of these, on its own, is manageable. None of them are a problem in isolation. But when they arrive together, they don't replace each other, they stack.
So it's like three bills arriving on the same day?
Exactly. And none of them asked if it was a good time. When investors think about selling, they usually ask, what's my tax rate on the gain? And when they see the number, they think, that's manageable.
Famous last words.
Very famous. Because the surprise usually isn't the rate itself. It's how many different pieces show up at once and how they interact with everything else on the return. Here's the part people don't emotionally prepare for. All the tax breaks you enjoyed earlier don't disappear. They come back as a bill. Example, $150,000 of past write-offs can turn into over $37,000 of tax.
That stings.
It does. And that reaction is exactly why people remember this moment. Not because the math was complicated, but because the timing felt unexpected. I hear this all the time. I'll be in a lower bracket later. And on the surface, that assumption feels reasonable. Work stops. Income slows down. Life simplifies. But in real life, later often means something very specific. It means selling assets that have been quietly building gains for years. It means required withdrawals from retirement accounts that don't ask whether you actually need the money. And it means Medicare surcharges that kick in based on income you didn't expect to count this way. None of those feel like high-income moments. But for tax purposes, they stack just like income does.
So later isn't actually lower.
Exactly. Later isn't lower. Later is just later. The bracket doesn't care why the income showed up. It only cares that it did. Here's the good news. There is a window where you still have control. Not complete freedom, but real, meaningful control over timing. For most people, that window sits roughly between ages 65 and 75. During those years, a few important things line up. You may no longer be earning a salary. Required distributions may not have fully ramped up yet. And large asset sales haven't always happened. That gap matters, because it's one of the few periods where income can be shaped intentionally instead of forced by the rules.
So that's the calm before the storm?
Yes, and storms don't care if you're ready. Once required withdrawals begin, once properties are sold, Once income starts stacking automatically, control narrows very quickly. This window isn't about doing everything at once. It's about recognizing that timing still works with you for a while. Smart retirees don't just ask one question. They don't stop at, how much do I need to spend? They ask a second question, and it's the one that usually matters more. Where should that money come from? Because the source of the dollar often matters more than the dollar itself. The same amount of spending can land very differently on a tax return depending on whether it comes from cash flow, sales, or forced withdrawals.
Same money, different damage.
Exactly. Low-income years are valuable. They don't feel dramatic. They don't feel urgent. And because of that, they're often ignored. But from a tax perspective, they're some of the most flexible years you'll ever have. They're like empty lanes on the highway. Everything moves more smoothly. You have room to change lanes. You're not being forced into traffic. Those years give you options before income starts stacking automatically.
And most people wait until rush hour?
Every time. They wait until required withdrawals begin. Until asset sales are unavoidable. Until income shows up whether they want it to or not. By then, the lanes are full. The speed is set. And every move costs more than it needed to. There's one more surprise that catches families off guard, and it usually shows up much later than people expect. Heirs don't inherit your timeline. They inherit rules. Rules about distributions. Rules about timing. Rules about how fast income has to be recognized. What felt flexible during your lifetime often becomes rigid for the next generation.
And rules don't care about intentions.
Exactly. Here's what people say after the fact. Not during planning. Not during growth. After the bill shows up. I didn't know it stacked. I thought it would happen later. I thought I had more time. Those sentences sound harmless, but they usually come right before a number that permanently changes how someone feels about their plan.
Those are expensive thoughts.
Very, because by the time you're saying them, the timing decision has already been made for you. This isn't about avoiding tax forever. That's not how the system works. And that's not the goal. The real choice is simpler and harder. When does income show up? How does it show up? And at what cost? Real estate rewards planning. It rewards people who think in sequences, not events. But it punishes delay. Not loudly. Not immediately. Quietly, years later, when timing runs out. The biggest tax hits don't usually come when you buy real estate. They show up at selling, at retirement, and at inheritance. That's where timing matters most. Plan early. If this helped you see how timing really works inside the tax system, subscribe to IV Smart Tax. We focus on long-term tax strategy, no hype, no shortcuts.
Which part surprised you the most?
Comment below. We'll cover it next.